I'd like to welcome you to the Chapter 1 intro, where we talk about uh, the basic parts of what this class is going to be in the setup for the class. So this is Intermediate 1, and so we're going to be doing financial accounting. And like I alluded to in the course introduction video, financial accounting is the basis for all of the different types of accounting. So you pretty much have to have a good understanding of financial accounting in order to do any basic accounting type thing. And so this differs from managerial accounting, which you probably studied in your Principles 2302 class. It differs from tax accounting. It differs from governmental accounting. There's all sorts of different types of accounting that are done. And so we do financial accounting, and that includes the concept of accrual accounting, which you should have been introduced to in Accounting 2301. In accrual basis accounting, we count our revenues when they are earned, not when we collect the money for them, so when they're earned. And we count our expenses when they are incurred, not when we pay for them. In both cases, revenues and expenses, they can be paid for in advance, they can be paid for after the fact. But in accrual accounting, we base the accounting statements on what was actually done during that time period, what costs were incurred during that time period, the expenses that were incurred during that time period. And sometimes because tax accounting, there are differences between tax and financial accounting, for example, because we try to differentiate, we need to differentiate what we're trying to prevent. In financial accounting, which is what we're doing now, the focus is to prevent making ourselves look too good, right? So the rules that are in place for financial accounting are put there in order to give a fair representation. We'll talk about these terms in just a minute, but to give a fair representation of what we're actually doing, so we don't puff ourselves up too much, and that would cause investors to and creditors to possibly look at us in a more favorable light than we deserve. In tax accounting, on the other hand, the government is concerned that we don't understate our income, and so it's kind of the exact opposite of what they're trying to prevent in financial accounting, because if we understate our income, then we underpay our taxes. And so the different types of accounting will have different focuses. So on financial accounting, and we'll talk about those focuses in just a couple of minutes here, but in financial accounting, we are preparing financial statements for external users. So people like creditors who may want to lend us money, or be willing to lend us money, or investors who may want to invest into our income, or regulatory agencies who look at did we make a fair profit on things? Are we overcharging? What should a price be set at, a maximum price be set at, those sorts of things. So we need to be aware of that. Now, those rules that I alluded to in financial accounting are known as GAAP, GAAP, capital letters. That stands for Generally Accepted Accounting Principles. And we try to follow GAAP whenever possible. We can have accounting systems that are not according to GAAP. They're called OCBOA, Other Comprehensive Basis of Accounting. But GAAP is what is the standard and is recognized in financial accounting. And GAAP goes through a standard process. The regulatory board, there's a number of regulatory boards for financial accounting. The one that most is most dealt with is called FASB, the Financial Accounting Standards Board. There's an International Accounting Standards Board for international accounting standards. We use U.S. accounting standards, which are known as GAAP. International standards are known as IFRS, International Financial Reporting System. But GAAP is kind of you would say, the Bible of U.S. accounting. And it comes from a number of sources. FASB is the most recent one, but we also, the Securities and Exchange Commission is very integral in creating accounting standards, and sometimes FASB and the Securities and Exchange Commission differ, and that gets to be interesting fights that occur among them. And then we have the PCAOB, which was created after the accounting scandals that occurred in the 1990s and culminating in the early 2000s. Enron is the most notable, but there were a number of them. There were WorldCom, Parmore, just a whole lot of different accounting scandals. We'll talk about those as the semester goes along, what they were particularly doing. Anyway, one of the things that you should be aware of is that accounting is going through a very dynamic phase right now. The rules are changing at a very rapid pace for rules being changed. Obviously, it's not like what's happening with the internet or anything like that speed, but a lot of that is due to technology. As things improve, reporting gets to be more timely. We can do it quicker. We can do it with less hands-on. One of the things that you'll need to be aware of as you go through your accounting career is that we will be moving, for those of you who get into auditing, we will be moving from a transactions-based audit to a systems-based audit. What does that mean? Well, now we go through and we verify that the transactions that are recorded in the accounting books, and they're electronically recorded in computer books, but the transactions that are recorded in the accounting books are accurate. But as you know, if you go to a store like a Walmart or a grocery store, they scan almost everything, and it just goes through a belt. And Amazon, as you've probably heard, has experimented and has a number of stores where you just go in, load your cart, and you walk out the door. You don't even have to go through a checkout. They through RFID and other measures, know exactly what's in your cart and know how much to charge you. So as we move to less human involvement, more point of sale, we have less human data entry. The movement will be less from auditing transactions into auditing the system that records those transactions. And so that's going to be a huge difference as we move forward. So if I were you, just a thought, if I were you, I would make sure to get a good information systems background, data analysis background as you move through your career. That will keep you current on what's going forward with things. Now, these rules that we've adopted as a society. As I mentioned, they are changing, and the movement is more from a rules-based to a principles-based. Now, what does that mean? Right? Well, a rules-based says that if you sell money and you have a contract, that is a sale, and so you record a revenue. But a principles-based would be, well, is it really a revenue? Is it, it's not hard and fast. It's like, do they have the right to return it? How long do they have the right to return it? What percentage of people actually do return things? So you would look at more of a big picture. This makes the accounting a little bit more difficult as we go forward, but it's also part of the nature of the society that we live in today. And so that's kind of important. Okay, now out of chapter one of the things that you need to know is on page 19 of your book is a conceptual framework. And if you look on that conceptual framework, you'll see in the middle they have the elements. That's things like assets, liabilities, owner's equity, revenue, expenses, all those things. The only thing you might not have run into in your Principles 2301 course is comprehensive income. And we'll talk about that in a later chapter, but that's probably the only thing you don't know there. But over on the left-hand side, you've got these qualitative characteristics, and these are very important. There's something that you need to look at and need to be very, very familiar with. And the two qualitative characteristics are relevance, and then now they use the term fair representation, which I mentioned earlier. Fair representation. In my day, when I was sitting where you're sitting learning accounting, the conceptual framework used the terms relevance and reliability. Reliability and fair representation have just a slight different meaning. Fair representation is more of an enhanced meaning. It kind of shows up in this move from a rules to a principles based, that we want to, when we prepare a set of financial statements, we want them to show what's really going on in the company and not be deceptive in any way whatsoever. All right, so in that, in the relevance, it's broken down into three subcategories of predictive value, confirmatory value, and then materiality. Of those three, materiality is the most important concept. Is something material? And you may have heard that in your first accounting class. Is it material? What material means in an accounting sense is it enough that it makes a difference to a user, to a reader of a financial statement? So, to take, for example, if we're talking about a large company such as Amazon, if they're off by $100,000 in one of their accounts, it really doesn't matter. It's not going to make a difference to anybody. It's a multi-billion, possibly $1 trillion company. And if they're off by a few thousand, 100,000 even, nobody's going to care. It's not going to make a difference. On the other hand, if we're talking about mom and pop's little corner grocery store, convenience store type thing, and their records are off by $100,000, that's going to make a huge difference, right? And so that's the whole concept of material. Will it make a difference to somebody? And that's a very important concept. One of the things that always cracks me up, you get people who will spend countless hours balancing their checkbook, getting down to the very penny of what's in their checking account. Well, there's a cost-benefit analysis to that. If I get within $5 on my monthly statement, that's close enough. I'm not going to spend 3 hours looking for $5. It's just not worth my time, and it's not worth most people's time. And so materiality is a very important concept. That being said, there is always one thing that is material, and that is fraud. And the reason fraud is always material is because it says that your internal controls are not sufficient. And so you don't know what else is wrong, right? So fraud is always a material element. Then on the faithful representation, we have completeness. Have we described all the transactions that should be in the financial statements? Are the financial statements complete? We're not leaving off these little side deals that may have occurred. And then there's neutrality. Back in my day, we used to use the word objectivity. Neutrality just means I don't create a favorable view. I don't create an unfavorable view. Objective was slightly different. Objective is the concept of two professionals given the same information would arrive at basically the same conclusion. And so neutrality is very important. Now, contrast this to tax accounting, where we're actually allowed to be an advocate for our client, right? We don't have to be neutral there. Now, we still have to be within the rules. We can't bend the rules, break the rules, but there are a number of things in tax accounting where issues are not settled because of court cases and that sort of thing. We're allowed to take a position most favorable to our client in that case. That's not true in financial accounting. We're supposed to take a neutral position, one that most accountants would come up to the same basic idea on. And then the last one of those is free from material error, free from error. In other words, we just don't have a bunch of mistakes going through the system. And so that's an important part of this. So anyway, this conceptual framework, I want you to take a look at and to understand. Now, down at the bottom of the conceptual framework, they have the financial statements. There are 4 financial statements. There is an income statement, there is a balance sheet, there is a statement of cash flows, and then there is a statement of changes in owner's equity. But then there is also the disclosures. Financial statements are not complete without the disclosures. Disclosures are often known as footnotes. We are required to make certain disclosures when we issue financial statements. What is our basic accounting principles? Do we use LIFO or FIFO on inventory? Do we use a time-based depreciation, or do we do an activity-based depreciation? These are all things that we have to disclose so that a reader of financial statements is able to have an understanding of what we're putting forward. And then over there on recognition and measurement, we'll get into that more in later chapters, so you don't have to look at that quite so much. But one of the things that we look at in the is the full disclosure of things, and that's part of the principles that we want to get into on that. All right, there are also a number of underlying assumptions in accounting. And the first one is that it is an economic entity. So we're not commingling money between the owner and the owner's company, right? That the economic entity stands on its own and the financial statements represent just the entity itself, not the owner's things. 2, it is a going concern. What does that mean? A going concern means that we expect the business to be in business for the foreseeable future. Think about it. If you run into a business that they have a going out of business sign, don't you walk in and expect to get a discount? They may be selling things at less than cost. So going concern is very important. We think that the business will be in business for the foreseeable future. Now, no business lasts forever, so this will be violated at some point. But when we issue the auditor's report, we state that this is a going concern. If it's not a going concern, or if the auditor has questions about it being a going concern, they will issue what's called a going concern paragraph in their audit opinion. The third one of the underlying economic assumptions is periodicity. We make financial statements on quarterly and annual basis. So, if you think about one of my favorite products would be like Jim Beam bourbon. Well, the economic cycle of a bottle of bourbon is 5 to 7 years. You start with the sour mash, you put it through the thing, you distill it, and then you put it in barrels and you let it sit there. And you don't collect the revenue from 5 to 7 years from when you started the process on that. But even though we do that, even though that is the accounting cycle, we're still going to issue financial statements on an annual basis. And so we have to, we have the periodicity assumption. And finally, the last one is the monetary unit of assumption. Believe it or not, you can issue financial statements in just about anything. Up until the Great Depression, there was a cotton company based in New Orleans that issued their financial statements every year in bales of cotton. And then readers would have to translate what a bale of cotton was in terms of dollar value. But we use the monetary assumption. So in the US, we use the dollar. If you were in Europe, you would use the euro, Japan, the yen, China, the yuan, and etc. So we issue financial statements in the common currency. And this gets to be one of the big issues in accounting is when we have multinational things doing foreign translation, foreign currency gains and loss, foreign currency translations, foreign currency gains and losses, because foreign currencies can be very volatile. So those are the things. All right, so out of chapter 1, the most important things. Understand the conceptual framework. In particular, the qualitative characteristics, those are important. There's some narrative in your book right after page 19, and you'll want to read that on the qualitative characteristics, and then the underlying assumptions. If you know that, you'll be good to go for chapter 1. All right, so thank you, and we will see you on chapter 2 and possibly some problems.